Welcome, everybody, to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the pleasure of being joined by Robin Finlay, Managing Director over at Arrow Capital. Robin, thank you very much for joining us today. Maybe you can start by just describing who Arrow Capital is and maybe a little bit about yourself as well.
For sure. Thanks very much for inviting me on the show. As you said, my name is Robin Finlay. I am the Managing Director at Arrow Capital. We are a Canadian-based alternative investment manager based in Toronto. And we've been doing this for just over 25 years and have a lot of experience both in the good and maybe in the not so good. And it's served us very well to get us to where we are today. We run about 1.7 billion in assets. And I've been part of this organization since 2002. So very much involved, engaged, and immersed in all things alternative.
Right on. Well, we're here to talk to you, of course, about your alt positions and the way that they fit in, I guess, in today's environment. Most certainly, we're in a very volatile period of time, and a lot of people are looking for private type placements that kind of gets them away from the traditional daily liquidity, but also the daily valuation that happens in traditional financial markets. So. Maybe you can start, I guess, by describing, what's the purpose of Arrow, why does it exist, and how are people using it?
So we're very much in line with what you just described. We are very interested in seeking out investment opportunities that, or maybe a more accurate way of describing it would be investment strategies that capture a rate of return and a risk profile that isn't necessarily generally represented by just owning stocks or bonds or cash, sort of the traditional investment vehicles. We work in an area called, in industry speak, called liquid alternatives. So that puts us in a spot that's between a mutual fund and a private placement type vehicle. And what I mean by that is we still have daily liquidity like a mutual fund would have. It's still reported on a client statement the same way as a mutual fund would be. But we are able to do some different things inside the portfolio in terms of strategy that allows us to capture some of those returns that I spoke of at the beginning that maybe aren't readily available just to traditional stock and bond investors.
Maybe on the liquid alt front, because Tyler and I, we work in both. We work in the traditional alts that aren't daily liquid, and some of yours that we've worked with are liquid daily. So what is the risk in the alternative space when you run something that's daily liquid? And I think for your situation, obviously your underlying assets are liquid daily, so therefore it makes it a bit easier. But what would you say is the risk for any investment that is considered an alternative, but it's has daily liquidity? What could be the risk there?
Yeah, I think the risks are relatively well aligned with just being a traditional investor. There's a risk of loss, permanent loss. Obviously, if you buy something at one price and it goes down and you decide to sell it at that price, that's a permanent loss of capital. That certainly exists. We do things like short selling, which means we sell a security without actually owning it. We borrow it so that we can sell it. In that scenario, if that security appreciates in value, we're also losing money on that. So there's risk there. In some cases, there may be leverage utilized, which of course, that means there's a third party involved who has lent money and is required repayment under certain terms. So that could be an element of risk. I think what's key here is that if you apply these sort of additional features to someone who doesn't have a great deal of skill to utilize those features, that in itself is the risk. This is very much a skill-driven proposition because there are more tools at the disposal of the investment professional. And so our job, in addition to running the money, is to make sure that we have investment professionals that are capable and that we have risk controls in place to make sure that they're following the guidelines that have been outlined in the prospectus, as an example, for each of the investment vehicles. So there are risks. I would say the biggest risk is lack of skill set to utilize the tools that you have, especially in the liquid alternative space. It seems as though we have a few participants in the space that have been long only mutual fund managers, as an example. And because there's a bit of a cachet or a flavor for alts today, they've all of a sudden started a liquid alternative fund that has more tools than maybe what they're used to utilizing. That's a little bit of a yellow light for us. We want to make sure that there's a skill set there that has some capability. I'm not painting a brush across all of them. There's definitely some depth in a lot of these firms, but where we come from, we've been doing this for 25 years and we've only been doing this. So we feel like we're in a position of competitive advantage from the ability to utilize the tools and execute the stated results.
Yeah, so, I mean, great comments on what the risks are. I think it's probably something that's left off the table in some discussions are what are the risks for holding certain products or certain investments. And I mean, effectively, that's the discussion of alts. You can buy yourself a long fixed income portfolio and you're going to get fairly similar returns across most of those options that we have. In order to get the return that we're looking for, there's an expectation of a higher return. There's an expectation that you're taking on some additional risk to do so in that fixed income space. And I think for a lot of our clients and a lot, look in the last 10 years, I mean, you could have pretty much made zero return in a long fixed income. So having this as a component, we'll talk a bit more about one of your specific holdings or styles of what you're using and how that enhancement happens. So thanks for those answers.
Yeah, so if we're talking about your income advantage alt fund, Robin, something that Dave and I have used in portfolios, what particularly about that fund requires it to be considered an alt classification? So how is it different, I guess, than a traditional bond mutual fund that a lot of people might have exposed in their portfolios?
Right. So we are in the alternative space for a very specific reason. And we can get into a little bit of the details of how this works. But at a high level, we're delivering on a fixed income mandate that isolates only part of what a traditional bond vehicle would deliver. Said a different way, we have eliminated all of the impact of changes in interest rates on our fixed income portfolio. And for those that are viewing, if you've owned bonds over any period of time and you've been in conversations with your advisor, you have come to the understanding that interest rates have a big impact on bond prices. It's a little bit clunky relative to, say, what equity prices do, but there's definitely a big impact. And if you kind of step back a little bit and think about it, interest rates were very favorable for bond investors from about 1993 to, let's say, 2015, and then they paused for a little bit. It was a little bit lumpy, but then in 2016 through to 2022, basically, interest rates basically went down every day. And so if you were a bond investor, a traditional bond investor, that was good. That was a tailwind that worked in your favor. Fast forward to today, from 2022 till now, we're in a much different rate environment. We've obviously seen rates go up very quickly in 2022. And I would argue today that you're probably looking at a range, and if I talk about on a 10-year bond basis, government bond basis, you're probably between sort of 3 and 6%, but no longer are we going to be starting from, say, 10% and working to zero. That was very favorable for bonds, traditional bonds. Today, you have far more volatility on interest rate movements and ultimately on bond prices. So when we structurally remove that component from our bond portfolio, it eliminates, approximately 70% of the risk in owning a bond. And let's face it, people own bonds not to own risk. They want that to be the secure part of the portfolio. It's supposed to be the buffer against equity volatility. Well, traditional investors in bonds over the last 3 years have realized that they've got considerably more volatility over that period of time than they had in the prior 15 years, for example. So that's where we go to be able to eliminate that big risk component in bonds, that being interest rates. And the way that we have to do that means that we have to be in the alternative space because we need a few more tools to be able to accomplish that.
Great. So, I mean, in that, and you mentioned some of the tools when we talked about why it's an alt. So, by mitigating and taking away some of this risk that's somebody who's in just a straight long bond mutual fund, what is the potential for risk on your side then? Let's say we're reducing 7% of the risk against a normal bond fund. Where does it go bad? Where does it go wrong for you? What kind of things have to happen for your fund to, say, be outperformed by a long bond?
Right. So the most obvious one is if we see a big run up in interest rates here and they peak out and then they start to come back in quite aggressively, that is going to be a favorable environment for a long bond investor. Interest rates that are going down, long bond investors win. We will make some return there, but I doubt that we would keep up with a long bond investor because they will have a portfolio structure to benefit at the maximum from that type of rate environment. In our world, because we've eliminated the impact of interest rates, we have really left only one part of what that total interest rate paid by the bond is, and it's called the credit spread, and it's the amount that the corporate bond issuer has to pay to the lender in order to incentivize them to lend. So in other words, if a Government of Canada bond will pay an investor 5%, if TELUS wants to borrow money from an investor, they have to pay more than 5%, or else there's no incentive for anyone to do that, to lend them money. So our entire investment exposure is focused on that extra amount that an investor will receive from a corporate issuer over a government issuer. How does that go sideways or wrong for us? Well, that little piece extra that is paid by the corporate issuer is called a credit spread, and it moves around based on economic conditions on a macro level. Also, it moves around based on what's happening within the corporation and the quality of their balance sheet. So it in itself will go higher and lower, but it's not nearly as volatile as what interest rates do. Because in our case, at least, we are focusing only on the highest quality bond issuers in Canada. So that would be bonds that are rated at BBB or higher, which is commonly referred to as investment grade bonds. They're the highest quality corporate bonds in Canada. That is the only thing that we invest in the portfolio. And there's purpose behind that, and that is investment grade bonds, all things being equal, virtually always mature on their maturity date. They don't default because they're the highest quality issuers. Now we're talking about TELUS, Rogers, all the Canadian banks. Those types of issuers are who we're talking about and who's in the portfolio. So the credit spread is an amount that they have to pay in addition to what the Government of Canada pays. And as long as those bonds mature at par on time, we will capture all of that credit spread. So while there may be risk between the time we purchase the bond and the maturity date, and when I say risk, I mean that credit spread could go higher or lower. Ultimately, if we hold that bond to maturity, we're going to capture 100% of the credit spread. So to answer your question more directly, there is mark-to-market volatility, i.e. the price could move around days, weeks, and months. But ultimately, unlike owning a stock or unlike owning a high-yield bond vehicle where there may be a risk of default, we know that our bonds are going to mature on the maturity date, And that extra amount that the corporation has to pay, we are going to receive it.
Nice. Well, and that was kind of, we were going to get into credit spreads on our next question. So you got us there already. So what's a typical core investment allocation in the fund look like?
So typically a core investment, if I break it down into sort of one single investment, and we can kind of walk through what that looks like. So if you think about a traditional bond fund, one investment would be, okay, they bought XYZ bond for X% of the portfolio. In our case, we only buy Canadian investment grade bonds, but ours is two-sided. So let's use an example of TELUS. We buy a TELUS bond, we put $1 in that TELUS bond, say it's a 10-year TELUS bond. So we invest $1 in that TELUS bond. At exactly the same time, we will actually sell short a Government of Canada bond that has the exact same term to maturity as the TELUS bond. So our one single transaction that has two sides is, on the long side, we've paid $1 for a 10-year TELUS bond. And on the short side, or on the sale side, we've sold a Government of Canada bond also of 10-year duration. So now what does that look like? In the portfolio, you have two bonds, one's been bought and one's been sold. Now, how do we sell the Government of Canada bond? Well, we actually borrow it. Where do we borrow it from? We borrow it from pension funds, big institutional investors. They own tons of these things, and they're always happy to lend them out because they'll make a little extra return. We have to pay rent for that bond that we borrowed. Once we borrow it, we're able to sell it. Now, here's where it gets interesting. When we sell that Government of Canada bond to match off against the TELUS bond that we bought, we've sold it, so we actually get the $1 in proceeds back, just like you sell anything else. So we use that $1 in proceeds to actually pay for the $1 that we spent on the TELUS bond. So now you have long $1 in TELUS, short $1 in Government of Canada, but we haven't used any money. The investor that put the dollar in to facilitate that whole transaction starting, that dollar actually sits in an overnight money market account earning interest. So we've got $1 long and $1 short, and we haven't used any money. So that's the first part. Now, the second part is, why do we need two sides of that transaction? Well, that comes back to my discussion about eliminating interest rate risk or interest rate impact. If we just own that TELUS bond, when interest rates go up, that TELUS bond becomes worth less. Conversely, when interest rates go down, that TELUS bond becomes worth more. When we put the Government of Canada short right beside it, there's opposite effects on both sides of it. So if you think of it like a teeter-totter, if interest rates go up, the TELUS bond goes down, but the Government of Canada short goes up. So net, we lose no money. On the other way, if interest rates go down, the TELUS bond goes up, the Government of Canada short goes down, net, we lose no money. And so we do that for every single corporate bond that we own. We offset it with a short position in a Government of Canada security. Both of them are highly liquid, so we have no liquidity risk. And both of them trade every single minute of every single day. So we know that when interest rate changes occur, we're going to get an instant correction between our long and our short, so that we have no net impact from interest rates on the portfolio.
So essentially, when this happens over a long period of time, you're just making the spread.
Correct. That credit spread that I mentioned earlier, that's all that's left over, because the interest rate portion is offset. So just to let's use simple math. Let's say the TELUS bond pays 6% and the Government of Canada bond pays 5%. Those are make-believe numbers because that's not where the market is right now. But that 1% difference is the only thing that's left over, because the first 5% of the TELUS bond is offset by the short 5% that the Government of Canada bond pays out. So those two things net out. So all that's left is the 1% extra that TELUS is, as I said, required to pay in order to get people to lend to them. Otherwise, why would you lend to a corporation when you can lend to the government?
Great. So that kind of runs into the next question. How do you enhance the return of the portfolio?
Right. So you'll remember that when I said, when we short a Government of Canada bond and we buy a TELUS bond at the same time, the proceeds of the short is used to buy the TELUS bond So we don't use any money, and the client's money sits in an overnight bank account. So because those are both highly liquid vehicles, the people that facilitate those transactions for us, they are willing to extend us a form of leverage that allows us to do that multiple times for the same dollar invested. So for example, right now, we are about 2.5 times levered in the portfolio. Now, for most people, when they hear leverage, they think, oh, you really like something. You had $1, you borrowed $2.5 more, and now you have $3.5 invested in something you think is really going to work. That is a form of leverage. That is not the way that we work here. So recall, I said that we own $1 long and we short $1 and we don't use any money. So we do that same transaction 3 times or 2.5 times in this case. But there's still only $1 invested by the client. But because we can use the proceeds from the short to purchase the long bond that we want, we can build our little teeter-totter and not use any money. And because those are highly liquid vehicles that are coming from a marketplace that's very liquid and very active, we have no concern over being stuck or unable to sell or buy back either side of that transaction. So it's really quite low risk. The people that provide the facility for us to be able to do this, they will actually extend leverage in this format to us up to 10 times. We've never used that much. We max that out at 3 times. But it is a very liquid market. It's very, I guess the word's easy. It's probably not easy in that sense, but on a relative basis, because of the liquidity and the availability of those securities, we're able to use leverage in that way. But we always say there's no recourse. And what I mean by that is we have no risk of the government of Canada bond being called away from us by the person that owns it. We've got a contract with them that lets us keep it. The TELUS bond is the TELUS bond. We have no risk of default because it's a high quality credit. And because the short sale of the Canada is financing the long purchase of the TELUS bond, we're not using any money. We're literally not borrowing any money from a bank or any other intermediary. So there's no loan that can be called. Unlike my initial example where I said, you know, you borrow $2 to add to your $1 to get $3. Well, you've borrowed that money from someone, and depending on what the stock is that you bought with that money, they may or may not want their money back, and it may not be at a time when you want. We do not have that risk here. So we call that non-recourse leverage.
That's perfect. I mean, in your earlier example, we kind of, just establishing as a sample, we had a 1% gain on an initial investment. So when you multiply that 2.5 times, you'd have a 2.5% gain against our previous example. Yeah.
Right.
And it's those tools that you're using that basically require this to be labeled an alternative. So this two-sided transaction, the shorting that you're doing, as well as the leverage, creates the requirement for this fund to be an alternative investment strategy.
That's correct. You would not be able to structure a trade like that in a long-only mutual fund. The rules wouldn't provide for that. We put ourselves in the alternative space to be able to create a two-sided transaction that limits risks, even though it's using leverage. I know it's very common for people to say, oh, you're using leverage, it must be risky. I would argue in our case, because we have two sides of the transaction that are eliminating the biggest risk on a bond, that being movements in interest rates, and we don't borrow any money from everyone, I would say that our form of leverage actually reduces your risk in this type of investment.
Right, and your comment was where you might be vulnerable would be in a falling interest rate environment after it peaks out. But okay, in that example, fine. So you don't perform as well as a long bond. But let's look at the other situation. 2022, when interest rates fired up, what would have? I mean, I think our fixed income side would have been minus 15, minus 16%. What would have something in this strategy perform in a year like that?
Okay, so in 2022, our calendar year return was 2.3% positive. Now, that sounds fantastic. How does that work? Again, you just go back to that simple teeter-totter. Interest rates were going up, going up, going up. So our TELUS bond was going down, 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 down. but our Government of Canada short position, because it's inverse, it was going up, 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 and the whole thing was offsetting the cost of this TELUS bond on a mark-to-market basis. So our portfolio didn't really move a whole lot. Where did the 2.3% come? That was the credit spread that we captured over that 12-month period. Okay. Similarly, you know, if you go back to 2020, March, whatever it was, 13th of 2020, it's a date that we all would rather forget, I'm sure, than remember. There was a big, big move in short-term investment grade bonds to the negative. The reason for that was basically every financial market participant was trying to raise cash and trying to raise cash from a security that was as close to being reasonably priced as possible. Guess what that was? That was short-term investment grade Canadian bonds, which we owned a ton of. And at the same time, they were buying Government of Canada bonds to play defense. So we had a mark-to-market period there of about a week where the fund was down 13%. Now, it's these kinds of examples where I remind people that we own Canadian investment grade bonds. So even in a, you know, world is ending kind of scenario that we thought maybe we were in there for a week or two, once things settled down, it very quickly became aware that, hey, these Canadian investment grade bonds, they're money good. They're going to continue on. They're going to continue to make their interest payments. People are kind of got back to a more centered reality and, you know, went back to kind of rebuilding portfolios in a more traditional sense. And so the result of that for us was, yeah, the month of March was minus 13, but by August we were at 0 year to date. And by the end of that year, we were up, I think, 7 or 8%. So that was all as a result of the fact that we own high quality Canadian investment grade bonds that we know are going to mature at par. Every single investor, I always encourage them to say, just look around as you drive downtown or drive around your neighborhood. All those businesses, those big businesses that you see in every city, those, we own their bonds. They're not going anywhere. So it's high stress situations like that that are a really good bellwether for us to identify with people that, look, it might not look great on paper, but these bonds are going to mature at par. And as long as we as long as we hold them, we're going to be just fine. But it's a very extreme scenario for sure. 2022 scenario that you referenced, that's a more reasonable, you know, we need to raise rates because things are getting ahead of themselves, and we can do a very good job there of holding capital values very stable by virtue of the structure of the portfolio.
Thanks.
So with the interest rate risk being sort of, you know, the core risk of a regular bond fund, can you describe what the main risk is in your portfolio? So you've got this massive shift during COVID where you had businesses shutting down and there was this fear that these massive companies weren't going to open their doors again. And that's an unrealistic fear, obviously, but is that really the risk that you're running here? Or what is the underlying risk that that isn't interest rate risk like we experience in long bonds?
Yeah, I think the real risk, and I mean, outside of COVID, that was a one-off extraneous variable, just general market operations. And I mean, I think right now is probably as good a time as any to talk about general market operations, because every day there's some discussion about tariffs and where they are and if they're being applied or if they're not being applied. So there's some volatility in the market. Our risk is the price of the corporate bond in respect to how much that credit spread changes in relation to the rest of the marketplace. So it could change for two reasons. People will actually take investment grade bonds and sell them if they're really concerned about the market environment. They only want to own government bonds. So that will make the credit spread move wider, which again, it's counterintuitive, something like bond prices. If credit spreads go wider, that means the value of that credit spread is lower on the client statement. In our case, though, because these bonds are highly anticipated to mature at par, that risk is completely temporary. Because unlike a stock, when a stock gets beat up and is down 20%, one could make a determination that it's good value. I like the dividend. I'm happy to buy it at this price. but there's no guarantee that that will return to the price it was before it went down 20%. There is zero guarantee of that. In our world, we buy a corporate bond, even if that corporate bond starts going down in value and it shows a negative return on statements on any given month or quarter, ultimately that bond is going to mature, and it's going to mature at 100 cents on the dollar. That is a very key factor in this portfolio strategy. It's all Canadian investment grade bonds. That's a very homogeneous group. They're very protective of their balance sheets in order to keep that credit rating. And anyone who doesn't have an investment grade credit rating in Canada is doing everything they can to try and get one, because once you're in, it's very hard to be, you do everything you can to keep it. So yes, there's mark-to-market risk in the interim, but ultimately, unlike a stock, we know the bond matures at par, and when it matures at par, we get the credit spread. It's undeniable. It's pure math.
So with that, just for the fact that, you know, we deal with a lot of people where we've used long bonds, and we deal with a lot of people where we've used this type of investment. If you were having to make the case, you know, from a long-term point of view, a 5-year, 10-year, because that's what we like to talk to our clients about, what would you say the difference in return would be on a 5 to 10-year basis of this type of investment versus a long bond, and what would be the volatility difference between the two?
So if we start from right now going forward 5 years and 10 years, because that's reality, I think it's fair to assume that we're going to have a lot of variability in interest rates for a lot of reasons: tariffs, where we are in the economic cycle, risk of recession, you know, government debt levels. You can go on and on and on. All those things are going to impact where interest rates go. And so that's going to mean volatility in bond portfolios. I think it's going to be a real challenge for traditional bond holders. I think they're probably looking at a number that's like 5, maybe, over the next 5 to 10 years. If you made 5% in bonds, I'd call that pretty good. In our scenario, I think we can improve on that, because we can use a little bit of leverage. We can multiply the number of bonds we own for the same dollar. So that affords us an opportunity without adding really additional market risk, because it's all done on a market neutral basis. I think we could be, you know, closer to 7 over time, but it's not really anything magical. It's just that we have the ability to take $1 and make it work like it's $3 in certain scenarios. And also, because we don't have the interest rate impact that causes, you know, negative periods of time, like 2022, for example, we spend very little time replacing capital that we lost as a result of movements in interest rates. We spend very little time. We spend no time on that. We do have to spend time on protecting what happens with the credit spread. And there's some other things that get done in the portfolio that are supplementary to that core strategy, and they are there specifically to offset any negative impact of credit spreads. I mean, outside of a COVID scenario, if you get a COVID scenario, it's kind of all bets are off. Although never lose sight of the fact that we own investment grade bonds and they mature at par. So unless that company ceases to exist, we're going to par out over time. But to answer your question directly, I think we could add 1 to 2% over your long traditional exposure over that time period. And I think we can do it with lower variability of bond pricing over that time.
Great. And I would say that's, if we look backwards 10 years, that's what we would see as well. So.
Yeah,
Like
that's a significant difference.
Yeah, the last 10 years has been, you know, that was a big tailwind for long bond investors. And so the challenge now going forward is you don't have that tailwind. So how else can we generate real income from fixed income? Because I'm not really a believer of, and I'm not judging. I don't believe in we'll build a blue chip dividend paying common portfolio, and that will be where we get all the income from. The income will be fine, but the volatility on the capital values, that's a different story. So in this case, if we're talking about fixed income, I want to be able to provide a fixed income product that generates income from coupons. And that's what we have here. We just eliminated the one part that we don't want. That is, what do interest rates do to this bond portfolio day to day?
Correct. Nice.
Yeah, it's been a good fit. Takes the rockiness out of a portion of your portfolio that you don't want to be rocky. So very good case to be made about the, the traditional 60-40 portfolio. Has that gone the way of the dodo bird, and should stuff like this be introduced now on the fixed income component to add that lack of volatility and lack of exposure to interest rates? So that's excellent, Robin.
Yeah, and I want to stress too, like, this is not a be all end all. It definitely forms part of a bigger machine called the fixed income allocation. Because if you do, let's say, for example, that interest rates go to 6% and the next move is from 6% to 3%, your long bonds are going to do very well. We'll make some money, but we won't make as much. Conversely, if they go from 3% to 6%, that's where we'll do a little bit better and they're going to struggle. But this is why you kind of, they work very well in tandem with traditional bond exposure. So, people say, oh, well, why don't I just put it all in here? I don't have to worry about interest rates. And go, well, you might want to have some interest rate exposure from time to time. So that's where you guys come in to be able to structure that piece of the portfolio to optimize it as best as possible.
Well, that's exactly it. I mean, when we're talking to our clients, I mean, most of the investments of the world that are available everywhere are available to our clients. So it's kind of commoditized. So it's really about tactical asset allocation for us. It's being in the right spot at the right time more often than not. And it's just maybe being a little bit more overweight in certain positions and underweight in others, and then fixing that. So that's why this is a great tool that I would say most investors in Canada don't use and don't have available to them. So we're grateful to have that as some options. And yeah, thanks very much for sharing the information with us.
Yeah, happy to. I'm probably thought of as being a little nerdy, but I kind of find this stuff interesting to talk about, because the alternative space is one where we're constantly looking for ways to grind out a little bit of a return, but not have the traditional market risk that would be associated with that return. And, that's not everybody's cup of tea, but that's what we spend all our time doing. And I find it really interesting. And it's really rewarding to see it work in a portfolio and kind of do its job, if you would.
Well, it may make you the cooler of the nerds then, because maybe a long bond guy who finds it completely fascinating is the nerd. And since you guys get to play around with it a bit more, it makes you the cool nerds.
Yeah, I can't stress enough though. You gotta hire people to know what they're doing.
Yeah, for sure. Well, Robin, thanks very much for joining us. If you guys want to learn more about Robin Finlay, he's of course at Arrow Capital, and you can always find us as well on our socials or follow us at towerwealth.com. Thanks again for being here, Robin. Hopefully we'll have you back again sometime.
It was a pleasure. Appreciate it very much. I look forward to coming on again.
Right on. Thanks again. Bye for now.